It's 2 minutes past 10 in London. Welcome everyone to the Refinitiv OPEC webinar. Quite a popular series that we organize every year, and many of you dial in and listen to our experts year after year speaking about OPEC. Obviously, while the actual OPEC meeting is still being discussed and finalized, I think it will be an excellent opportunity to hear our experts today speak about the supply-demand balances, the market insights, and the issues that the OPEC will face in the future as well. So many thanks again for dialing in and joining us for this webinar today. I'm really delighted to have two of our experts on the call today who will be taking you through the different market insights and the views that we have on the OPEC side of things as well. First of all, we have Yaoyan Chong, who is the Director of Refinitiv Oil Research. YC, as we call him internally, he is based out of Singapore, and he's the inspiration, as we call it, behind the Asian oil flows assessment module that was introduced in ICON, and it provides the fundamental assessment of cargo flows across the oil barrel to and from demand and supply regions and everything else. YC obviously has a long, lengthy experience in the oil industry across multiple different companies, and he's been a Reuters energy correspondent as well. Joining YC on the call today will be Georgios Bellaris. He's the research manager for us in EMEA, oil research team manager. He's been a major contributor across the research and development of the team's oil flows module. Obviously a product that multiple of you as clients utilize, and many across the industry are also utilizing it as well. He's based out of Dubai, and he's the one who conducts research across Middle East and North Africa as well. Georgios is obviously, I think, to mention, one of the people behind our Twitter channel. So if you do engage with us on Refinitiv Energy channel, chances are you might engage with Georgios as well. So just quickly introducing the speakers before I invite them to properly start the webinar. A few housekeeping announcements. As you might have noticed, this is a listen-in only webinar. So you must be listening it via your laptop or PCs. So if you can't hear anything, turn up the volume on your laptop or your PC or any other device that you're looking through for the webinar, and then you will start listening into it. We will have questions, so you will see a Q&A box on your screen as well. If you do have any questions, any issues, technical issues and problems, please feel free to put in through via the Q&A box as well. And there are a few resources and other things as well that you guys can utilize via the resources tab as well. And again, quickly, many of you might be aware of this already, but a quick reminder that we are now Refinitiv. So formerly the financial and risk business of Thomson Reuters, many of you might be aware of us as Thomson Reuters. We are now Refinitiv, and we are the dynamic combination of data, insights, and technology, along with the news incorporation of Reuters supporting us for a long time. And this is our way forward to drive the market with greater insights, technology, and data analytics as well. So with that, I would like to hand it over to Yan Chong now. Yan Chong, over to you to get the webinar started.
Right. Thank you very much, Rohan. Hello, everybody. Welcome to the webinar again. So let me just take you through what we have to say. The first thing, basically, I'd like to sort of introduce the Reuters or Refinitiv Commodities Research Division. We are an independent unit that was set up within the old Thomson Reuters structure in 2011 as part of the company strategy to provide exclusive content. Right now, we have about 150 to 200 analysts globally covering the three major commodity asset classes, being energy, which includes oil and power and gas, and agriculture and metals, and each with their own team of analysts. Okay, and obviously we sit on the oil side, Georgios and me, and this oil research unit, basically what we do is we specialize in producing near-term, in-depth analysis of supply-demand fundamentals for each oil product group by region. So what do I mean by that? Actually, well, one of our primary products, we call it flows, right? Basically, we are tracking oil flows around the world from the perspective of a region. So from my perspective in Asia, say on crude oil, we will see crude coming into Asia. Oops, something wrong with the slide. Let me just go back. Yeah, so we'll see crude, how much crude is coming into Asia in real time, and we break that down into the major importing countries such as China, India, Korea, Japan, etc. Okay, from Jojo's perspective, right, from the Middle East, it is basically a net exporter of crude, so they would be looking at how much crude is coming out of the region as a whole, specifically and from the perspective of the major exporting countries like the Saudis, or well, Iran is a major talking point right now. The other product that we produce, we call it curves, for price forward curves. Okay, and well, we produce a price forward curves along the 24-hour timestamp. Okay, and this price forward curves basically covers across the entire product spectrum on a 24-hour follow the sun basis. So we have 5 timestamps within the 24-hour clock. Okay, so enough about us. Just let me. Okay, this final slide shows you. Well, obviously the flows that we do, we need to benchmark ourselves against something. So in our case, we benchmark against customs numbers where possible. And the slide's a little small, but the top part of the slide show the flows benchmark for Asia. So for example, crude into China, we are about 99 to 100% versus customs. The bottom part shows you the slides for the Middle East, and we are sort of close to 100% or slightly more for the major exporting countries, and particularly among the OPEC members. Okay, just the last little slide, a pat on the back on ourselves is that, well, this is the Energy Risk Asia Awards that we have won 4 of the last 5 years. Okay, so let's just go into the presentation proper. I mean, the crude market has been bullish and bearish intermittently depending on what happens geopolitically. Okay, so like the major questions that we are looking at, for example, fundamentals in our minds have been bullish, right? There have been escalating tensions in the Gulf, particularly lately with the 2 tankers being attacked. Waivers for Iranian oil has been withdrawn, or they were not extended. So that has also led to, and that was unexpected, and that has led to a tightening of markets. Okay, OPEC Plus is still talking about when they're going to have the next meeting, early July probably, but we expect them to extend the production cuts or the output cuts beyond the current June expiry. Okay, the loss of about 5 million tons of supplies in Europe, to Europe, via the Druzhba pipeline, that should take about, latest is about 2 months to clear, but again, that basically has tightened supply. U.S. sanctions on Venezuela and its own deteriorating production, that has also removed quite a bit of supply from the market, right? And then we have new refining capacities coming up here in this part of the world, in China, particularly in China, as well as Malaysia and Brunei. And, well, basically, Chinese demand has been yet at another record high. For a 13th consecutive year, we are averaging in excess of 40 million per month, as we will see in greater detail later. Okay, and there are at least 2 refineries with a total capacity of 800,000 barrels per day that has come up or are coming up. Okay. But however, this upside is limited by obviously huge U.S. production that has surpassed 12 million barrels per day in February this year and forecast to hit 13 million barrels per day by Q2 2020. The U.S. is now the world's largest crude producer, having overtaken the Saudis and the Russians. Okay, the other item that has been basically bearish on the market is the trade wars between the U.S. and China and Mexico seems to be solved, but that has impacted economic sentiment negatively, and that has led to lower front-month Brent prices. We are down sort of like $61, $62, right? Okay, and with that, I will hand over to Georgios, who will talk to you about OPEC from a supply perspective. Georgios, please.
Okay. Thank you, Yang Chong. Hello, everyone, and welcome to our webinar. Thank you very much for joining us. So as mentioned earlier, I myself am based in the Middle East and conduct research on the supply side of the market for the most part. It's definitely been a very interesting year so far from an oil supply point of view. We've had the OPEC agreement, which is yielding good results. Supplies dropped to 4-year lows in May. I mean, the group collectively has managed to push its output significantly lower. Obviously, some members have contributed more to that. Some others have contributed less. In terms of the early parts of the quarter we're at, of the second quarter now, we saw actually the production itself decline lower than the pledged levels, as you can see on the right-hand chart. The biggest contributor of which has been Saudi Arabia, of course. The country has been quite proactive in reducing production and supplies into the global market, with other countries, namely Iraq, kind of failing in a way to achieve the committed cuts. But that's generally been offset by the collective decline, and as you can see, there's been significant drops. Right, moving on to the next slide. In line with the exports, with production, exports of crude from OPEC have also declined. Last month was a unique month for exports. We had exports a little bit below 22 million barrels, which has been the lowest since we started tracking oil movements globally, which was in 2015. So obviously there's been major disruptions within the group. Iranian volumes have sort of fallen to multi-year highs. Also Venezuelan volumes the same. But apart from these disrupted countries, as you can see on the second and the third chart towards the right hand, the group itself has seen steep declines in exports compared to the pledged cuts. So that there's been strong correlation in that with a massive decoupling towards the downside in May. But then the OPEC's 11 members that actually have committed to cutting production, and that excludes Libya, Iran, and Venezuela. Again, there's been strong correlation between the production level, or at least the pledged cuts, and the actual exports. This is very interesting because in previous rounds of cuts, let's just say in early 2018, most prominently, this wasn't necessarily the case. We had seen a little bit of a divergence between production and exports, but so far this year it's been on the same page. Moving on, as I said, May has been, let's just say, a very impressive month for OPEC standards. We've seen total volumes exported at 21.75 million barrels. Obviously, the decline in Iranian volumes has been very, very big. There's been roughly about 600,000 barrels, or a little bit more than that, exported from the country during May, although quite far from what the U.S. would have hoped, I guess, since the sanctions are in full effect in May. Still, the country has exported that amount of crude. But what's interesting is that other countries in the Middle East also saw their exports decline. We saw steep declines in Kuwait, more than a year low, so the lowest level in more than a year for Kuwait. Similar for the UAE. Saudi Arabia has kept its export fairly stable in the last 1 year at just below 7 million barrels. So all of these cumulatively pointed to a quite scrutinized picture in terms of the exported volumes from the group. As we're going to see later, I think the pricing element had the role to play here as well, because OSPs were quite aggressive during April, and I think that may have spilled over into May loadings from the group. Yeah, I mean, in terms of Iran itself, the country has gone.
Right, I think Jürgis has some technical issues, so let's wait till he dials back in. I know some of you on Q&A have put in that you can't hear us, so we'll quickly reconnect with Jürgis, and then we will continue from this point onwards as well. I think, Wesley, you're with us?
I'm here. I think the problem is that you're just on the sound.
Sure. So we'll wait for Jürgis to dial in, and then he can get started from this point onwards. We have a number of questions coming in as well. I know some of you have been asking some specific questions about the supply balances, the issues on the supply side as well. So please do keep typing in your questions while we wait for Jürgis to dial back in.
Apologies. I think the audio is back. Apologies for the technical issue.
There we go. Jürgis, gone?
Yeah, all right. Okay. Apologies again for that. Just to carry on where I've left. So I was talking about how Middle Eastern supplies were interestingly low from most exporters during last month. And then how the OSP that was quite aggressive during April may have may have spilled over and affect the May loadings as well. So moving on to the next slide. So in terms of where OPEC's crude is heading towards, obviously the largest part of it is still going into Asia, and if we are to look at the average of the first 5 months of 2019, we see that there is a minor increase towards the aggregate volumes at almost 15.8 million barrels per day. When it comes to the U.S., I think this is where we've seen the biggest declines in terms of the shipments. Obviously, the fact that Venezuela does not send any crude to the U.S. anymore is factoring in largely. And finally, the crude that the group is exporting towards the Northwest Europe and the Mediterranean has also declined, and this would be more on the back of Iran not exporting to many of the Mediterranean refineries, which have traditionally been among the biggest suppliers of the country. In terms of condensates, very briefly, obviously the group lost a lot of condensates in the beginning of the year when Qatar decided to leave the group. On top of that, the declines in Iranian shipments have also factored in. The truth of the matter is the tracking of the Iranian cargoes has become extremely challenging, and the separation between crude and condensate remains very hard. So these two reasons have led to a huge decline in condensate exports from OPEC. Now, if we are to look into Saudi Arabia in particular, interestingly, we'll see that exports to China have increased on average year to date. They've reached 1.4 million barrels per day. This is significantly higher compared to the same period a year ago. I believe Yang Chong will be talking about how Saudi has actually become the top supplier of crude in China in 2019. Also, we've seen Saudi exports to the U.S. declining year to date. And I mean, in regards to the expectations for Saudi exports as we go on, I wouldn't necessarily expect a big recovery into that. Obviously, it's the summer here in the Middle East, and domestic demand tends to pick up in Saudi Arabia. So exports from the kingdom are likely to stay at current levels, which has been consistent for most of 2019 so far. Yeah, as I was mentioning, you can see on the right-hand chart that black oils tend to spike during the summer months. Black oils meaning crude oil, direct burn, and fuel oil demand. That said, in terms of crude oil direct burn itself, we've seen the seasonal peaks sort of declining in each iteration of the season. So that's quite interesting. I think Saudi Arabia is more keen into processing this crude in its refineries rather than consuming it directly. In terms of the crude inventory levels in Saudi Arabia, it's been a very nice decline between October 2015 and now. I think the total decline is about 130 or so million barrels, which is generally in line with the position of the country in terms of reducing global stockpiles. I mean, they've been achieving this domestically in their country. A little bit of more complicated picture in other countries. Moving on into Iraq. Iraq, has been quite interesting because they've been achieving higher exports for the most of the year. I mean, they reached a record level in January at 4.1 million barrels. This is inclusive of Kirkuk crude exports from Turkey. What stands out for the country is the fact that they've increased their total volumes towards India. Again, another big buyer of Iranian crude, which obviously has had challenges importing Iranian crude given the sanctions have been in place. We've seen Iraqi volumes towards India spiking in January above 1 million barrels per day, and they've generally kept at quite high levels near that level as in January. Exports to China have been fluctuating in general, but overall they've been higher compared to a year ago. Moving on into Iran, the elephant in the room, I guess. As mentioned earlier, exports have collapsed, generally in line with the fact that very few people are actually buying Iranian crude at the moment. As mainly India and China. There was a spike in March where the country exported about 1.6 million barrels just before the waivers end. But ever since, there's been very little volumes leaving compared to a year ago, of course. It's interesting to see that earlier in March there was a decoupling between what production was quoted to be in Iran from secondary sources, from Reuters OPEC survey, and what the exports were, which points at quite interesting, depleting theoretically storage of crude. However, if we are to look at this next slide, a lot of the Iranian vessels, the vessels owned by the National Iranian Tanker Company, have been offline for more than a month. Now, naturally, what has happened during previous rounds of sanctions, Iran tends to increase its floating storage, given that they own a quite big fleet of large vessels, VLCCs and Suezmaxes. These have typically been used for storing crude oil, and given the fact that a lot of these vessels have been offline and they're not able to be tracked, it builds the case that this could be a scenario taking place again, where a lot of these tankers are being full and they're just waiting for future buyers. Of course, outside OPEC, within the OPEC Plus sort of group, let's just say, there's been another significant disruption, the Druzhba pipeline of Russia. The volumes being transferred to Europe came to a stop because of contamination. Overall, however, we've seen Russian crude production, as you can see on the left-hand side, it has been declining through the months in 2019. That said, interestingly, there's been a decoupling between refinery throughput, which has been presenting steep declines, and naturally the excess crude has been exported. What's more interesting to see, I think, during April and May, where the disruption happened on the Druzhba pipeline, exports in general, they didn't seem to be affected in the grand scheme of things, which points to the fact that crude was probably redirected through other outlets of the pipeline, of the Transneft network of pipelines or ports, especially seaborne crude exports spiked last month, sort of offsetting the outage of the pipeline. With all of this into account, the fact that we've had significant removals of, let's just say, medium or sort of heavier crudes from the market, this has led into a quite tight medium crude market. We saw the Dubai Brent EFS sort of coming towards its historical lows earlier in the year when waivers were approaching towards an end for Iran, and then Venezuela sanctions came in place. So obviously that it removes significant supply of medium or let's just say heavier crudes on the lighter spectrum. Obviously, the spread has recovered a little bit, and that could be on the back of what I was talking about earlier, the fact that OPEC exports have declined to historical lows, and this could mean that demand is probably driving that. And that has also affected the OSP setting for the major Middle East players. You can see in April most of the medium crudes from the Middle East were trading significantly higher. They were said higher than Dubai crude. Obviously, that's changed now. I think taking into account the fact that May levels were as low as they were. There's been some correction here, and I believe OPEC countries are hoping that will sort of reverse the picture and increase volumes. And with that, with the demand, with the pricing landscape in mind, I'll pass it on to Yang Chong, where he's going to speak a little bit about demand.
Thanks, Georgios. So we're back here from an Asia perspective, talking about the demand picture in Asia. So let's move into the first slide. Basically, Asia crude imports have been growing unabatedly in the last 7 years. If you see the red line is just one way up. And we are averaging up to May this year at almost 93 million tons a month. Okay, this is up from 2018's average of 90.3 million tons per month. And this is way above 70 million tons a month just 6 short years ago. Okay, and OPEC by far is the largest supplier group into Asia, as you can see from the pie chart with a big orange circle. They account for just over 70% of total imports into Asia, and that's equivalent to about almost 74 million tons a month. Yep, and this is up from 63% or 64.2 million tons last year. So OPEC has stepped up and supplied more as a whole to Asia despite the production cuts. And if you look at the rest, Asia has been Russia has been sort of fairly steady at 6-7% or 7 million tons per month year on year. Most of the crude coming from their Far East oil fields. Similarly, volumes from the US, which started coming in 2016, have averaged just over 4 million tons a month, and this is nearly 4% market share, up from 3% last year. Okay, and this we expect the US imports into Asia to reduce going forward because of the escalating trade war, unless of course something happens in Osaka. Okay, from a country perspective, Saudi Arabia has become the largest single supplier to Asia, as they have been for the past couple of years. They have typically accounted for 20-25% of all flows into the region. For 2019, they are at 25% and averaging about 25 million tons per month up to May. And this is again a jump from 20 million per month in 2018. Okay, the other top 6 suppliers, Iraq, the UAE, Russia, Kuwait, and Angola, all rose, but the volumes rose, but their market share stayed more or less the same. Okay, in contrast, obviously expectedly, imports from Iran and Venezuela have fallen, respectively for Iran to 4.24 million tons per month, down from 5.68 million tons per month last year, and Venezuela is 1.38 million tons per month, down from 1.46 per month last year. Okay, we expect this, particularly the Iranian numbers, to fall further because of the ongoing sanctions. Right, but the thing to note is that the supplies from OPEC, and particularly the Saudis, have actually risen despite the production cuts. Okay, and this basically to us is a signal that the cartel and its allies have said, and they are doing it. They are making up for the loss of supplies from the 2 U.S. sanctioned countries. Okay, if you look at this, China is by far the largest importer in Asia and the world, and they have been growing steadily by an average of 10% a year every year for the past 12 years. The other major buyers are India, Japan, Korea, and Taiwan. We'll look in greater detail into each one as we go along. Okay, so among the total OPEC supply and among the 6 top buyers, China is the largest importer of OPEC crude since 2013, as you can see from the chart. So they are accounting for 22.5 million tons per month, or 36.5% of total Asian supplies from the cartel. Okay, and this is basically almost double from what it was in 6 years ago at about 17 million tons, okay, less than double. All right. India is number 2 at about 14-15 million tons a month with a market share of 22.4%. But this has been fairly steady over the past 6 years. For Korea, Japan, Singapore, and Taiwan, respectively, it's also been fairly steady at 14-15% for the Koreans, 17-18% for Japan, 4-5% for Taiwan, and 5-6% for Singapore. Okay. Basically, it's important to note that OPEC has not reduced supplies to Asia despite the production cuts. So they basically cut elsewhere, particularly, let's say, in the U.S., as we have seen. Okay? And we expect them to be committed to growing their market share in the growth markets of Asia, as they have been doing since the first time they did a production cut in 2016. Okay, let's look at China. Again, China, as I said, has grown, the imports into China have grown at an average of 10% every year for the last 12 years at least, if not more. Okay, today, we are averaging at about 41 million tons per month for this year up till May, and we hit an all-time high for China at close to 44 million tons in December 18. Okay, why is China buying so much? I mean, despite the weakening GDP, they are still buying that much. So what are the factors that are driving its seemingly voracious appetite? Basically, China has given import quotas to independent refiners. We used to call them teapots. They are not teapots anymore. They are actually quite sophisticated. Okay, and they have been giving quotas since 2015. And from 2015 until today, there have been a growing number of independent refiners that have been receiving quotas. So today we expect for 2019 the quota to be stable versus 2018 levels. We will take a deeper look at that as we go down. Okay? And basically, once you get a quota, this is fresh demand, because prior, these refiners were importing straight-run fuel oil. Okay, there are a couple of large new refining capacities that have been added into China, particularly this year, with 2 big refineries, Hengli Petrochemical, and which actually became fully operational this month, and Zhejiang Rongsheng, which will become fully operational sort of end Q2, beginning Q3, each with a capacity of 400,000 barrels per day. Okay. The other thing that's driving Chinese demand is the government's objective of having 90 days of forward cover, and this has led to about 42.7 million tons filling the SPR so far by Q1 this year. Okay, and this has been sort of actively filling since first half 2014 when phase 2 of the program started. Okay, the other thing that's driving demand in China is declining domestic crude production. They've seen output fall to an 11-year low of under 16 million tons per month last year. And this was versus a peak of around 18 million tons per month in 2015. Okay, let's look at each one of these items individually. Okay, this chart basically shows you Chinese domestic output, which is the blue line, and net import, which is the red line, right? And the yellow line is processing. So basically, what's above is what we believe to have gone into SPR, okay, over the years. Okay, we actually track the Chinese SPR regularly. We put out a number every week, and we close the number at the end of the month. Okay, so we estimate that the 90 days of forward cover will be the equivalent of 616 million barrels that would hold in their SPR tanks. Okay, their phase 1 and phase 2 have already been completely filled. So collectively, that's about 180 million barrels. Okay. Basically, what we are doing now is filling phase 2B, which started in earnest in 2014. There is a third phase that they have planned, but they have not disclosed capacity so far, which is supposed to start next year. Okay, of the Phase 2B facilities, okay, 3 of the 7 are already fully filled. This is in Zhoushan, Tianjin, and Huizhou, and collectively there are about 70.5 million barrels in there. There are 2 other sites in Jinzhou and Zhanjiang that are being filled currently. The Zhanjiang site has yet to fill so far. We have not seen it receiving any cargoes. And Jinzhou is about 40% filled. So we're talking about 121.7 million barrels under this phase now, in addition to the 70.5. Okay, so we have estimated that right now, as of March, actually should be May 2019, we have about 40.7 million tons in strategic storage, and that's about just over 50% of the 90 days cover. Okay, obviously, I mean, we are forecasting this, but how do we know whether we are doing it right or not? Okay, so we compare to official figures whenever they release it, and the Chinese government has only ever released official figures twice. The last time being for June 2017. At that time, they declared that the number was 30.73 million tons, and we had it at 38.58. So we are sort of at a variance of about 2%, which I felt was pretty impressive. Okay, the other thing, the pattern of filling and the pace of filling we noticed from about Q3, Q4 last year has actually tracked price, right? So when prices rose to above $70 a barrel and even crossed $80 a barrel in Q3, Q4 last year, filling stopped. So if you could see here, right, this was a period where they were not filling, and this was a time when prices went above $70. Again, this happened in April, May, when prices went up again. You know, briefly after the waivers were not extended, they stopped again. Okay, we fully expect them to resume, as we have been seeing in this month. Okay, the teapots. Basically, this is a list of all the teapots, the private independent refiners that have quotas so far. And in 2018, the quota was almost 114 million tons, okay, to 40 independent refiners. For 2019, so far the government has given about 74 million tons of quotas. They gave it in 2 batches. There's a second batch that is expected to come, and we expect the total quota for 2019 to be steady versus 2018. Okay, so how much have the teapots been buying? Okay, we track teapot imports every month, every week, okay, and they basically account for 20 to 30% of the country's total imports, okay, and they hit a peak of 11 million tons last December here, right, above 11 million tons. Basically, the pattern for the teapot buying is like this, right? So they will be given a quota. The quota will match their refining capacity, and they would buy up to fill their quota. They have to fill their quota. If they don't, they are afraid that the government will give them less next year. So if they don't buy, or they sort of pace out their buying through the year, come December, they are all in a hurry to fill it. Okay, hence you see typical spikes in December. Okay. However, we believe that going forward, further growth in terms of teapot imports may be muted simply because they are now overproducing. There's a glut of gas oil and gasoline supply since last year, and that has seen China's exports of the 2 products grow threefold in the last 3 to 4 years. Today, China is the largest exporter of gasoline in Asia. They are on par with India, and the second or third largest for gas oil. They are doing sort of nearly 2 million tons a month for gas oil. Okay. And basically, we expect the year-on-year quota volumes to be steady. This is despite the 2 big refineries coming on stream. So that tells you that the government is probably moderating how much they are giving now. Okay, basically, as I said earlier, the domestic crude production of China has fallen very sharply. So from a peak of 17.8 million tons per month to under 16 million tons now. Okay, and we expect this downtrend to continue, despite I think last 1-2 years, the government has mandated the China's majors to spend more money to extract production from mature fields. Production has not gone up, and in fact, it's continued to drop. Okay, let's look at who's supplying into China. As Georgios have shown earlier, the Saudis are now the top supplier into China with about 8 million tons per month or 17% market share. They overtook the Russians for the first time in 4 years. Okay, Russia is slightly less at 7.7 million tons, but they're still 17% market share versus 6.5 million tons a month a year ago. So both the Saudis and the Russians have increased their volumes into China as well as their market share. Okay, Angola, Iraq, and Brazil are the next largest suppliers. They are sort of fairly steady on year at 12, 10, and 10% respectively. Okay, and obviously imports from Iran has fallen to 2.04 million tons per month, down from 2.44 million tons per month a year ago, while Venezuela exports actually have been fairly steady at 1.4, 1.5 million tons per month. Okay, India. Basically, the largest supplier to India is Iraq. They're averaging about 4 million tons a month, up slightly higher versus 2018, but enhancing its market share to 27%. Okay, the Saudis are second, as they have been. Again, they have increased their market share to 23% from 19%. Okay, in contrast, Iraq, which used to be one of the largest suppliers into India, has seen its market share fallen to 6%, down from 12%. And the volumes, a sharp drop from 4.8 million tons a month to less than 1 million tons a month. Okay, and Venezuelan exports fell, but by a slightly smaller margin to 1.38 million tons per month versus 1.46 million tons per month a year ago. Okay, let's look at Japan and Korea. That for both, there are little change in terms of the supply structure. The Saudis remain the largest supplier to both countries, as they have been for the past 10 years, with market share of over 40%, followed by the UAE with a 20 to 25% market share. Okay, basically, Iranian imports to Japan fell to about 460,000 tons per month this year, down from 570,000 tons per month in 2018. Likewise, okay, however, for the Koreans, okay, they are actually still fairly steady, if not higher on average, at 775,000 tons per month versus 600 per month last year. But we expect this number to drop because the Koreans have already stopped taking condensates from Iran for May. In fact, in May, it was 0. So let's look at the impact of Iranian imports into Asia. Okay, basically, they expectedly fell from May, right? With May arrivals, we're looking from an arrival perspective. So most of this loaded in April, right? So for May, about a total of 1.64 million tons arrived, down from 6 million tons for each of the last 2 months. Okay, only China and India saw May arrival volumes from Iran, and even that at vastly reduced levels, right, as you can see from the table. And basically, as you can see, the gap left by the lack of Iranian imports have largely been filled by Saudi Arabia and the UAE for all 4 countries. Okay, down to a vessel level for India in May, we saw 2 vessels arriving from Iran, but both loaded in April, so that they don't count, right? But we believe there is at least one May arrival, another May arrival, which actually loaded about 100,000 tons offshore neighboring Iraq. We believe that one should be carrying Iranian barrels. Okay, China has 5 May arrivals, totaling 1.36 million tons, with one loaded directly from Iran in May. So they did not quite exactly follow the sanctions, right? At least one came. And there are quite a bit of Iranian barrels in this bonded storage in Dalian in China. And we would expect those barrels to come back into the marketplace, whether into China or elsewhere. I believe probably would be more likely just China. Okay, for South Korea and Japan, as seen earlier, there were 0 arrivals from May, and we expect this to stay 0 going forward. Okay, Venezuela. However, unlike Iranian imports, Venezuela volumes to Asia did not actually fall by much after the sanctions took effect in January. And inflows are still averaging 2-3 million tons per month, only to India and China. Okay, in fact, the drop in Venezuelan imports is more due to its own deteriorating infrastructure rather than U.S. sanctions. Okay, this is because Venezuela's production has already fallen below 1 million barrels per day, right? And this was happening even before the sanctions were imposed. Okay, so most of its limited production are only going to importers with oil for investment deals, which is China, which invested in infrastructure a long time ago and is taking the oil as payment, and Russia's Rosneft, who are sending those barrels into India's Nayara Energy, which they own. Yeah? Hence, that's why we are seeing continuing volumes going into China and India. Okay, unlike the U.S. sanctions on Iran, the ones on Venezuela are slightly different, or quite different, in that importers are allowed to buy Venezuelan crude as long as the payments do not go to the Maduro government or PDVSA. So in the case of China, for example, the money has been paid for infrastructure investment a long time ago. They're just taking the oil as payment. They're not paying anything, right? For Rosneft, it's the same, and it's going to Nayara. Yeah. Okay, so basically, and these barrels, they can actually trade these barrels in the spot market because even if they're sold, the payments go to the owner of the cargo, not to PDVSA. So we do see some spot Venezuelan barrels being traded in the market. Okay, and for example, in the example of Citgo, who are now sort of under opposition control, they are allowed to actually buy or sell products in the U.S. because the money doesn't go to PDVSA or Maduro. Okay, so in conclusion, we expect the Asia market to remain strong, led by strong buying from China in the near term. We expect OPEC and Saudi Arabia to remain the largest supplier to Asia, despite the production cuts being likely to be extended beyond June, as the major producers continue to maintain and enhance their market share in this growth region, while supplies from Iran and Venezuela continue to fall. However, beyond 2019, we expect China's growth to be muted, not at the current 10% average that we have seen, but probably less, as we don't expect major new refineries next year. Okay, at the same time, because of the rising crude import quotas and the burgeoning refining capacities, we already have an overproduction of refined products since 2018. And with this weakening GDP, and exports tripling in the last 3 years, something has to give. Okay, and basically right now the private refiners cannot export their refined products because they have not been given any licenses to export. So that supply glut has spilled over domestically, and there have been sort of price wars at the domestic retail market. Okay, we believe that this situation is starting to become a little unsustainable, and the government would eventually have to start giving export quotas to at least some of these private refiners, sooner rather than later. Okay, and with that, thank you very much, and I shall hand it back to Rohan for questions.
Great, thank you very much, Ansham. Really insightful, good detail on the market and the insights. Now, I know we are pushed for time, so what we will do is to take one question each. I know there have been a number of questions coming through, so really appreciate all the engagement from everyone. What we will do is to save everyone time, answer one question each here, and then reach out to all your questions individually with the detailed answers that our analysts can provide as well. So, Jurgis, if you don't mind, I have this question coming in different ways and form. Iran, do you think the Iranian crude exports will go to zero as we go forward?
No, I mean, I think it's become clear by now that they probably will not. There is people willing to lift Iranian crude. We've seen many different clever ways of masking it and shipping it through ship to ship, or there's been many variations of exporting the Iranian crude. We can already say from May that there is interest in India and in China to lift. I mean, that was the expectation all along in any case, so I doubt we'll see them go to zero.
Fair enough. Okay, no, that's great. So one more for you, Jurgis. I think this came in a bit earlier. I'll read it out to you, and you can provide a response to it. The question goes by, as we know, U.S. oil production has jumped in recent years as a result of improved shale output. So far, logistics in the Permian Basin have curtailed even further output expansion. Do you expect the bottlenecks in this region to ease out in the second half of 2019? And how much of an impact do you think this will have on the oil prices?
Yeah, so I mean, there's a significant pipeline capacity that's being added in the U.S. now, which obviously will bring the crude closer to the coast and perhaps support the higher exports. But we need to keep in mind that we need to keep in mind crude quality here and crude gravity. Obviously, the American crude being quite skewed on the light side. Obviously, we need to see who are the refiners that tend to like consuming this kind of crude. And I don't think you'll find that many to take significantly more volumes than already taking. Obviously, U.S. exports at 3 million barrels a day, roughly. Nowadays, it's significant already. Going higher than that, you need to see light crudes. You're probably looking at higher yields of gasoline and naphtha, and then, if it is naphtha, then you need to look at perhaps the petrochemical units for marginal demand growth. So, I personally have a restrained view on the U.S. exports in terms of how much longer they can go, because it's a limited number of refineries that could show big appetite for it.
Great, thank you very much. Well, I see if I can get a question for you, and I think it's a big topic, the trade war that's coming up again and again. So the question for you is, how has the trade war impacted China's demand, and how will that play out going forward? I know you covered it briefly, but again, I think just as a question, I see if you can answer it.
Sure. I mean, from what we've seen so far, the import volumes, despite the trade war ongoing, have not gone down, right? So, I mean, there's talk that the trade war will impact economic sentiment and therefore, slow down in China manufacturing. Possibly, you may see it ease a little bit, but I don't think it will be a significant drop. What we will see, though, is that China, as long as the trade war is in sort of current severe situation, they will not take any U.S. crude. So if you look at the pattern of China bringing in U.S. crude, it's sort of more or less stopped in October last year when the trade war first surfaced, right? And that stayed at zero until April, May, when tensions eased, right? When we thought that, or everybody thought that they were going to make up, right? And at that time, they actually took back some U.S. crudes. But bear in mind, the U.S. crude takes 2 months to arrive, right? So this current escalation occurred sort of sometime end of April, beginning of May. So we would start seeing that impact this month, next month. right? But if all goes well in Osaka and they start doing it again, then we would start seeing barrels coming in up from August or beyond. Yeah, hope that answered the question.
Great, thank you very much, YC. I think we've just gone a minute over the time, so we will take one last question, and then, as I mentioned, we'll reach out to all the people individually as well. Jürgen, going back to the Iranian topic, I think that's a popular one. Short and sweet question: who will be replacing the Iranian barrels?
Yeah, I think, quality-wise, obviously the other exporters in the Middle East are very close. I think what we've seen so far is part of the Iranian sort of agenda seems to be passing on to Iraq already. I guess Saudi will definitely be a suitable candidate as well. The availability of crude is there, and the quality is comparable as well.
Excellent. Thank you very much. So I think we should call it the end for now. We will, as I mentioned, reach out to everyone with the individual answers to all the brilliant questions you all have submitted. So really appreciate the engagement from everyone. As a quick reminder, all the data, as you guys might read on the slide as well, insights, analytics from our team are obviously available via Icon. So please do consider reaching out to our research team, our experts, as well as all of our frontline individuals to engage with the research and analysis available via Icon for the greater oil markets as well. Highly appreciate everyone dialing in and listening to us today. Jürgen and YC, thank you again for presenting some excellent insights on the oil market globally. Let's see how the OPEC meeting plans out. No one knows at the moment, but hopefully we'll hear soon. But I do hope that everyone found this webinar really useful from our side as well. So thank you again, and we will hopefully see you soon in another webinar. Thank you and goodbye.
Bye.
Thank you very much.
Bye.